Hello, good evening. I hope we are all fine. All right, so we are back here again. I think the semester is fast approaching. It's let's say approaching. It's fast coming to an end, so we need to hurry up. I'll be doing it fast for us to start solving some questions, not maybe tomorrow or the day after tomorrow. Yeah. All right. So today we'll be diving into monetary theory as usual. No, not as usual. Yeah, so we'll be diving into monetary theory and then we'll be discussing this topic, transmission mechanisms of monetary policy. Right. So here, in between here, we are going to also diving into the demand of money. And I think that's where I'm going to end, and then I'll come back, and then I don't want the video to be long. So I'll come back and then come and then finish money supply as well. And then we dive in quick. All right. All right, so our learning objective for today is to list and then summarize the transmission mechanisms through which monetary policy can affect the real economy, how they can the monetary policies can actually affect the real economy, and also we should be able to summarize and apply the 4 lessons outlined for the conduct of monetary policy. So when we say the transmission mechanism of money, so this actually examines whether one variable affects another. So whether interest rates affect something, whether the real or nominal interest rates affect investments, whether it affect output, whether it affect uh, the investment output and the likes, right? So the transmission mechanisms here include a change in money supply, whether the change in money supply affects interest rates, whether interest rates affect investment spending, and also whether investment spending is investment spending is a component of aggregate spending, which is like output. So we have the traditional channel, the traditional interest rate channel, right? So for this one, it's a feature of interest rate transmission which emphasizes or which puts more emphasis on real interest rates. So here, what it means is that under normal circumstance, it doesn't use the nominal interest rate where it is just the normal interest rate. For the real interest rate, inflation rate will be catered for in the inflation rate has to be taken out of the nominal interest rate for us to get our real interest rate. So it is often the real long run interest rate and not the real short run interest rate. So this is viewed as having the major impact on spending. So now we are seeing something here, right? So what we are having here is when interest rate falls, what happens to investments, what happens to consumption, and what happens to aggregate demand. Now we can see here that once interest rate falls, we actually get more money, right? We are actually able to borrow more money, and then we actually able to invest more. And what does this also do? If we're able to invest more, we get more income. our consumption is automatically going to increase. Where when we get that money out, so the same thing is going to, when the consumption increases, it automatically means that our aggregate demand is also going to increase, right? Now, we also have the other asset pricing channels. So for this one, in addition to bond prices, two other asset prices receive substantial attention as channel for monetary policy effects. So what it has is that, what it does is that they actually examine how monetary policy is going to affect our exchange rates, and then also like how it is going to affect the exchange rates or internationally, and also the price of our shares, right? So here we are seeing that when the real interest rate falls, the exchange rate will also fall. Now, the reason is because when the interest rate falls, we are actually assuming that the economy is not that strong for the exchange rate to be high, right? So the exchange rate will also fall. Then this will help us be able to what? Export more, because since our rate is less, we're able to export more onto the market where people are actually seeing our goods to be relatively cheaper than the other countries, right? Since we're able to export more, then what? Aggregate what? Demand is also what? The demand on the market is also going to increase like that. Now, when we talk about equities as well, we already know that for equities, price and interest rates actually have an inverse relationship between them and then their prices. So when the rate falls, their prices rises, and when the prices rise, automatically the firm's value, which is the Tobin scale will also rise, investments will rise, and then aggregate demand will also rise. Now, when real interest rate falls here as well, prices will rise, our wealth will rise because our shares and then our investments are all going to increase. Then the consumption, because we have more money, we're able to consume more, and then aggregate demand is what? Also going to increase like that. Now, this is some link between the monetary policy and aggregate demand monetary transmission mechanism. So here we will be diving more into the Tobin scale later in this session when we are under the demand for money. But let's go through this. So it says that Tobin scale theory explains how monetary policy can affect the economy through its effect on the valuation of equities. It actually defines Q as the market value of firms divided by their replacement cost. If Q is high, then what it means is that the market price of the firm is relatively high to the replacement of the cost of capital. Now, the new plant and equipment capital is also cheap because now we are having more money, right? And when Q is low, firms will not be able to purchase new investment because their worth is low and they will not be able to purchase more. Now, when we remember way back in business finance 2 or financial management, we know about the efficiency, the Modigliani proponents, right? All right, so Franco Modigliani looked at how consumers' balance sheets might affect their spending decisions. So how your balance sheet is going to affect your spending decisions. When you have a good balance sheet, then you are going to be able to spend more. But if not, then you will not be able to spend more. So it says that consumption is spending by consumers on non-durable goods. So here we are looking at the spendings or the expenses we make on goods that are not going to last for a very long time, like food, like then not the one that will actually keep long. So an important component of consumers' lifetime resource is their financial worth. A major component of which is common stocks. When stock prices rise, the value of their financial worth also increases. Thereby, they're able to, it is thereby increasing the lifetime resource of consumers, and then the consumption will also rise. Now, when we enter the credit view are also saying that the satisfaction with the conventional stories, they have like this, they are not satisfied with the conventional stories that interest rates effects explain the impact of monetary policy on expenditures on durable goods assets held that on durable goods led to a new explanation based on the problem of asymmetric information. So here they are just trying to say that when it's initially without the financial intermediaries, there will be like an asymmetric information, right? Meaning that informations are not really spread to the end user, right? But here, because they are in here, those kind of barriers are actually broken down, right? So it seems that this explanation refers to as the credit view, proposes that two types of monetary transmission channels arise as a result of financial friction in credit markets, those that operate through effects on bank lending and those that operate through effects on firms and household balance sheets. Now, it further went on to say that bank lending channel is based on the analysis that demonstrates banks play a special role in the financial system because they are especially well suited to solve asymmetric information problems in credit markets. So, as I explained earlier, these people are there to make sure that informations are being spread to the end user well. So, they established that when bank reserve rises, bank deposits will also rise, bank loan will rise, investment will rise, and the aggregate demand will rise. Now, for the balance sheet channel, they are trying to say that unlike the bank lending channel, the balance sheet channel arises from the presence of financial friction in the credit market. So, according to them, when real interest rate falls, we actually know that price will rise. When the price rises, firms' net worth will also rise because their prices are high. Now, when that happens, adverse selection is able to reduce because here we're actually reducing the rate of giving money to the wrong person. And then our moral hazard will reduce because since we're actually giving money to the person who actually needs the money, he is able to use it to do what he wanted to do, right? And then that will reduce the moral hazard. Then increasing lending, since someone is able to do what he needed the money for, right? And then he's able to pay back, you're able to actually lend more, which will actually increase investment and also aggregate demand or output. So for the cash flow channel, it's also saying that another balance sheet channel operates by affecting cash flow, the difference between cash receipt and cash expenditure. So here it is saying that when the real interest rate falls, the firm cash flow will increase, adverse selection will fall. Always when adverse selection falls, moral hazard will also fall. Now when this falls, it's what increases lending and also investment, therefore increasing aggregate output. Now, you also have the unanticipated price level, which is more or less like the inflation, right? Another balance sheet channel operates through monetary policy effect on the general price level. So here we are saying that when interest rate falls, inflation will rise. Yes, when interest rate falls and we're able to get more money into the system, definitely if output doesn't increase in the same kind of proportion, then what it means is that inflation will rise, then unanticipated price level will also rise. Firms' real net worth, since price has increased, will also rise. Adverse selection will fall, moral hazard will fall, leading to an increase in lending and then an increase in investment, which will further move on to an increase in aggregate output. So we can actually connect this to the Great Recession. So the year between 1929 and 1933 witnessed the worst deterioration in consumer balance sheet ever seen in the United States. This is why I don't like everything. They are saying that we are using UK syllabus time, but almost all the concepts or theories that we are using are from US, because of the decline in the price level. In that period, the level of real debt consumers owed also increased sharply by over 20%. Now, consequently, the value of the financial assets relative to the amount of debt declined sharply, increasing the likelihood of financial distress. Now, it actually had some effect on the households. So another way of looking at how the balance sheet channel, I'm coming. All right, so another way of looking at how the balance sheet channel may operate through consumers is to consider the liquidity effect on consumer, durable, and housing expenditure. So normally when you get to the US and they release any news concerning the consumer durables and those kind of stuff, the way it really affects the market, Ghana has it, I don't know. If, as a result of bad income shock, consumers need to sell their consumer durables or house to raise money, they will expect a big loss because they could not get the full value of these assets in a distress sale. So basically, if you are really in need of money and you sell your phone less than the actual price, or when you sell your house less than the actual price that you should have gotten from selling that house, then it's actually going to affect you. You get it? So they will be facing what? A big loss. In contrast, if consumers held financial assets such as money, banks, stocks, and etc., they could easily sell them quickly for their full market value. So if they are not, if they were to be normal financial assets instead of the uh, fixed assets, right, they will actually get their full value, right? Because if you have a share and then you are selling it, you actually be selling it at its value, at least near to that value, right? So here we are saying that when the real interest rate falls, price will increase, and when price increases, value of household financial assets will also increase. Then it will lead to a likelihood of what? Financial distress, because prices has increased. Now, when it continues, consumer durable and household expenditure is going to increase, and then aggregate demand is also going to increase. Note that all the this thing that we are talking about is in the long run, not in the short run. So you have to keep that in mind as well. All right. So why are credit channels likely to be important? The first part is that a large body of evidence on the behavior of individual firms support the view that financial frictions of the typical crucial to the operation of credit channels do affect firms' employment and spending decisions, right? So whatever happens will affect a firm's employment and spending decisions, whether it affects it positively or negatively, it is going to affect the firm's employment and spending decisions. The other part is that there's evidence that small firms which are more likely to be credit constraints are hit more by tight monetary policy, right? So when firms are small and they are not about to grow, right, and then there is an increase in the monetary policy rate, they are not able to get more money to expand their business. So they are really hurt. Now there is also asymmetric information view of credit market imperfection at the core of the credit channel analysis. And it is that it is a theoretical construct that has proved useful in explaining many other important phenomena, such as why many of other financial institutions exist, and why our financial system has the structure that it has, and why financial crises are so damaging to the economy. Most of in financial crises are really sometimes they are needed because when you actually let's use the economy as a car, right? When you go when you're going too much speed and then you don't pause or you don't tear brakes so small, you're likely going to collude. Like let me say, you're likely going to get some accident or something. You get it. So sometimes when you cheat a brake, it's more or less like the crisis will come in some more, and then when you're straight road, and then wow, so huh. Now, to the application of the Great Recession with the advent of the financial crisis in the summer of 2007, the Fed began a very aggressive easing of money. At first, it appeared that the Fed action would keep the growth slowdown mild and the effect of recession. However, the economy proved to be weaker than the Fed or the private forecaster expected, with the most severe recession in the post-war period beginning in December 2007. So after the Great Recession, the central bank wanted to increase productivity and stuff, so they actually released more money into the system, and then interest rate was so low and stuff. But to their surprise, it didn't work as they were planning, right? So this is what is trying to explain. So why did the economy became so weak despite this unusually rapid reduction in the Fed policy instrument? So the other point too is, so you see, meaning that we are just trying to say that policy rate is not the only thing that is going to improve growth in the economy. There are so many other factors. So the subprime meltdown led to the negative effect on how the economy from many of the channels we have outlined. So the rising level of subprime mortgage defaults, which led to a decline in the value of mortgage-backed securities, and the CDOs led to large losses on the balance sheet of financial institutions. Now, with the weaker balance sheets, this financial institution began to deleverage and cut back on their lending, right? Because now they are really not seeing the distant top, so they need to cut it down. With no one else to collect information and make loans, adverse selection and moral hazard problem increased in credit markets, leading to a slowdown of the economy, right? Credit spread also went through the roof, and with the increase in uncertainty from failures of so many financial markets. So this is trying to outline or tell us why whatever they did didn't really work. So you see that the adverse selection was increased. So they actually gave money to the wrong people. More money was given to the wrong people, which they didn't actually use the money to do what they actually wanted to do, right? So some lessons we can learn from here is that it is dangerous to always associate easing or printing more money or the tightening of monetary policy with a fall or rise in short-term nominal interest rates. Other asset prices beside those on short-term debt instruments contain important information about the stance of monetary policy because they are important elements in various monetary policy transmission mechanisms. So the other, okay. All right, so now the third one is that monetary policy can actually be effective in reviving a weak economy, even if short-term interest rates are already near zero. And also, we should avoid unanticipated fluctuation in the price level is an important objective of monetary policy that's providing a motor for me. Sorry, that's providing a rationale for price stability as the primary long-run goal for monetary policy. Because remember, we established in the previous sessions that our ultimate destiny is to make sure that price is stable in the long run. Now let's move to the demand for money. Now the demand for money is actually how much like we need or we want to hold money at a given period of time and what we want to use that money for. So how much people want to hold, and the crucial question in monetary theory, whether the quantity of money demanded is affected by interest rate changes. Now, why demand for money? So the demand for is the extent to which demand for money is the extent to which demand for money is affected by changes in interest rate has important implications for the relative effectiveness of monetary and fiscal policy in influencing aggregate economic activity. So here we are coming to talk about the theories behind all this kind of money demand, right? So maybe from this one there, I won't actually be using the slide. Right. So um, we have some guys who actually have a theory behind this monetary money demand, right, or demand for money. So we have the Fisher, Ivan Fisher, or Ivan Fisher, Murphy. Then we also have we also have the Cambridge approach. And what happens here is that whenever this one brings a concept, the next one will come and then blast that concept and then bring another one or close to that one. Then the next one to also can blast the other guy, say, hey, ukwana wo yale. Honestly, the diaba. Now when so ever can say, I'm not bomb dance. I don't know who's doing so affected then. So that's what has been happening through this theory. So now let's take them one by one and then talk about them. So let's first talk about the I mean, let's first talk about Ivan Fisher. Or we normally associate it to equation of exchange. All right. So what Ivan Fisher was just trying to say that it was only focusing on the function of money as a medium of exchange, right? So it said that we have some basic components in this money system or money demand. So it has this formula like this. MV is equal to P times T, right? So here, it actually, so here, Ivan Fisher was just trying to say that if the velocity and the transaction of output remain stable, then price is actually going to be directly proportional to money, right? So we are going to dive more into this very soon. Oh, one friendly. So what Ivan Fisher was trying to say is that um, the theory of money demand was more or less like the transactions that we actually make, right? So he therefore said that the demand for money is purely as a function of the level of transactions generated by the level of income that we have, right? And that interest rate does not really have influence on the money demanded by us. So in this formula, we had MV is equal to P times T or PT, where M is equal to the quantity of money supplied and then V is the velocity of money. So for the V being velocity of money, it means that how many times the currency is being used is the velocity. So sometimes you can have or you can see some money be scanner bread, meaning that that money's velocity is very high. If you use data and then it has now gotten to then after the Adanin Tokwa. Now we also have the P. Is equal to the average price level or inflation. Or inflation. And then we also have the T, that is the transaction, the total transaction. All right. So now, what they actually said, or what he actually said was that, okay, let me rewrite this formula down here. Right. So the quantity of money supply times the velocity is going to give us the total money in circulation. So total money supply. And then this one is also going to be the total money demanded for transaction purposes. Right. So we further on went on and then we said that he further said that if we assume that the velocity and then the transactions is the same, like they remain stable, then M, which is money, and then P will actually have some influence on each other. So if we hold V and then C stable here, then you can see that since P is the price level, which is inflation, when M increases, P will also increase. And when M falls, P also falls, will fall. So we therefore conclude that money supply has a direct effect on the price level. So that was his conclusion on the money demand and how it affects inflation and the like. So we have this on a graph like this, where we are going to have quantity of money here and then price here, right? So we know that the supply is like this, then right. So here we are just trying to find the connection between that one and also the value of money. You could see that if this inflation actually increases, then the value of money will fall, because now money will not be able to buy the same thing again. Like if 5 cedis is able to buy one kinky, and then now the price of kinky increases to 6 cedis per kinky, you will not be able to use the 5 cedi to buy the kinky, right? So that's what I'm trying to do, the connection here like this. Use the demand. Then we also have P naught, P1. Right. So let's look at something here. So let's just say that this is the price level up here, right? So you could see that when the price level increases, then what it means is that the quantity of money has also what increased. Right. But when it comes to the value of money, right? When the price, let me use here value of money. Nowadays, let's say value of money 1, 2, and then 3. Now you can see that when this one falls like this, oh, so you could see that when the the price level increases, you could see that the value of money will also be falling drastically. When money is increasing here, you can see that the prices or the value of money is also falling. This is how you represent it on a graph, right? So Fisher went on to say that since we can actually move on to, I don't know where screen is. Since we can do a whole lot of stuff with this same formula, we can do it like this. V is equal to P T. Now we can do it like this. If we want to make M to stand alone, is equal to what? P T over V. Right? And that is it if we want to make M to stand alone. Now we can further go on to say that M is equal to 1 over V times Pt. Now we move on to make 1 over V k, which is a constant, right? So it is going to be something like this. And this is actually similar to what Cambridge also did. So from the Fisher's equation, this is what was derived for the Cambridge, right? So the Cambridge also said that no, some things cannot happen. But here, for that side, they actually focus and then change this T to Y. And we'll talk about that very soon. Now, he further went on to say that inflation and kasana is always a monetary phenomenon and can only be resolved through monetary policy and not fiscal policy. In the sense that if you are to use fiscal policy, then it means you are trying to either pump money into the system or take money out of the system. But with that one, maybe you might be printing more money. But if you are to only use the monetary policy rates, like the rate and the likes, then it means that there's no money. You're not going to put new money into the system, but you are going to use some tight regulations to make sure that the money is being reduced in the system. Now, it is this theory that was later converted into money demand. So he assumed that because the money market equilibrium requires demand to be equal to supply, then this is where we actually we make M the subject. And that was what I did up here. And then it was now PT over V, right? So a conclusion was made based on the assumption that money demand is determined by the value of transaction in the economy, which therefore depends on income. So because of that, we are actually going to get P over V, which is the value of transactions that we are going to make in the economy. So P over V is equal to the price divided by the velocity is equal to the value of transaction. Right. So I think that is it for the Ivan Fisher's own, right? So we further move on to the Cambridge approach. So for the Cambridge approach, it's also focused on two main reasons. That because money to Cambridge. So for the Cambridge approach, it focused on two main reasons. So it's more or less like the cash balance approach. Cash balance approach. So what the Cambridge people were trying to say that instead of looking at money only as a flow, like as like we are only using money to do transactions, right? We can also see money as a stock of words, meaning that people want to hold money at a certain period of time, right? So some people want to hold money at some time, right? So that was why this K came in. So this K up there in the formula up here is the holding of money, right? So let's talk about this. Let's talk about this. Now, this actually change. So people actually decide what portion of money to hold, right? So what portion of amount, like the portion that they want to hold out of their income. So it made the formula look like this. So MD is equal to KPY. Now, let me break this down where K is the portion. Then P is the price level as usual. Then Y is the real income. Right. So here, instead of T being the transaction, we are representing it with Y, which is our income. But it's the income that is going to help us do those transactions, right? Where MD is the money demand. MD is the money demand that we are having up here. So here they are trying to say that money demand depends on how much income people have and how much of it they want to hold as cash, right? So basically, if you have more income, you'd be able to hold more money as cash. And if you have low income, you'll be able to what? Hold less money what as cash. So they went on to tell us that people demand money for two main reasons: maybe because of a medium of exchange and then a store of value. So it's concluded that for money, a conclude that demand for money is for transactional purposes. Now, we can represent this on a graph here right now, right? So since MD is equal to what? KPY, then meaning that MS is equal to what? MD at equilibrium, right? MS is equal to MD at equilibrium. Then what it means is that at equilibrium, MS should be equal to what? KPY, right? So on the graph, this is our supply, and then So as we are having here our output curve and then our supply of money curve. So you can see that at various output levels, when money is being when money supply increases, you can see that what prices will also increase. So when money supply increases, then price level will also what increase. But if it were to be the vice versa, that's the same thing that's going to happen here, right? So I think that's it for the Cambridge approach, right? And then the Cambridge approach was being criticized, saying that it was being criticized by the Chinese, right? So the first of all, they came to criticize the Ivan Fisher's own that V and then T cannot be constant, and then interest rates was also neglected in the first kind of approach, and it's only applicable in the long run. So for Cambridge own as well, he said that K and Y cannot be constant as well, right? And then it also neglects interest rates and neglects speculative demand for money. Now, now we move on to the third one, which is the Keynesian liquidity. The third one. So for the liquidity preference, right, they thought of it that money is actually being held for three main reasons. Which is for transaction motive, as what we know already. It is to cater for our daily expenses, and then also for precautionary motive. Right? For maybe some emergencies or something. And then also for speculative motives. So for the speculative motive, if let's say we get some stocks or any assets at good deals, then we venture into it, right? So the Keynes actually criticized Fisher and Cambridge that assuming for velocity and K to be constant, he argued that money demand depends heavily on interest rates. So that's what he said, that if interest rate is low, then you are likely going to demand more money, right? You are going to hold more money, and when interest rate is high, it's going to be the vice versa. So let's take the point one by one from the top there, right? So for transaction, we know that transaction is we actually need money to what? Do our normal runs for the day, right? So people actually hold money because there is a gap between when money is received and when money has to be spent. So if you are working, you know that there is a gap between when you are going to receive your income and when you are going to spend. So people hold money to actually fill that gap. So people will hold money to bridge this gap. Now, how much will people hold? Will depend on their expected income. So if your expected income is high, then maybe you are going to hold a high amount of money. But if your income is low as well, you are also going to what? Hold less money. Price levels and also their habits and time being and between the time that they receive their income. So if you receive income on a daily basis, then you are hardly going to hold plenty money. But when you receive money on monthly basis, you are going to actually hold more money so that it can what take you through the this thing. Now the price levels are also important because when the price levels are high, you are going to hold more money so that you'll be able to buy more. Otherwise, and soon. But when the price levels are low, you are not really going to hold more money as well. Now, the larger the income, the larger the money they hold. And when income is received frequently as well, money is held, more money is held. And then if the income is received more frequently, then less income is what's held. Now for the precautionary one, so I've explained this. For the precautionary one, so for the precautionary one, you actually hold money for what? On like maybe some emergency that is about to happen, right? So this will also depend on your income level. When your income level is high, what will happen is that you're likely going to hold more money for any kind of uncertainties. But when your income level is low, you are going to what? Hold less money for this kind of uncertainties, right? So this is actually the basic one for the precautionary one. And let's go to the speculative one. So for the speculative, we actually want to see whether we are holding money even if let's say we get any opportunity that is actually going to get us some coins, then we venture into it, right? So speculative demand for money is influenced by the expectation of asset price, right? So when interest rate is low, we're expecting asset prices to what? To increase. And when interest rate is high, we're expecting what? Asset prices to reduce. That's why if you are expecting asset prices to reduce, you are not going to venture into it now. You are going to wait till it reduces before you venture into it, right? So meaning that if interest rate is high, if interest rate is high and you're expecting what uh, price to fall, what it means is that you are not going to invest now, so you are going to hold less money for this kind of precautionary reason. So when interest rate is high, we expect price to we expect price of bond to fall. So when we expect price to rise, we buy at lower price now, and we will lead. So we actually buy at lower price now, which will lead to a fall in the speculative demand for money. Also, when we expect price to fall, we sell the assets now, and then what? Because then when we sell the asset now, we get more money, right? And then the prices, the money demand will actually rise in case of that, right? So when price level is expected to increase, we buy now, and then when price is expected to fall, we sell now. Now, the Keynes concludes that demand for money is a function of output and interest. So meaning that demand for money is a function of output and then interest. So when interest rate is low, it will have an effect, and when interest rate is high, it will also have an effect. So it was actually connecting everything to the output levels, and then if there is full employment or there is no full employment. So we can put it on a graph like this. So this was trying to say that this curve is trying to say that when we have not really attained full employment in the economy, right? Now, what it means that output curve will be what? Will be rising, as we are seeing here. Will be rising. But when we attain full economy, a full employment, let me use it as FE. When we attain full employment, now you see that output will be straight. It won't be able to what? Increase or continue because we've attained what? Our full employment. Now, what this is trying to say is that when we've not attained full employment, price is going to what? Price is going to be stable, or we don't actually uh, care about price levels until we attain full employment. That's when we actually start measuring price level, and then that's when what price levels begins to what increase. Right, that's when it begins to increase like this. Right, so here price will tend to increase, right? So meaning that when we are not really at full employment, price will be what? Will be stagnant. What their price level will be stagnant until we attain full employment. That's the assumption behind the Keynesian's theory, right? So here we are just trying to say that price is not fixed as usual. So when interest rate is low, people hold more money and the vice versa. Now let's go to Baumol's thing. Baumol's theory, which talks about the inventory approach. And what he was trying to say is similar to what we've done in accounting and business finance, which is the EOQ, right? If you remember the EOQ very well, EOQ, we had the same kind of formula. So we had the same kind of formula, but I'm not sure this formula will be proven. We'll have to prove the formula during the exam, so we can prove the formula here. Right. So for Baumo, he actually suggested that relationship between income and money demand was neither linear or proportional. Transaction demand for money doesn't depend only on income, but also on interest rate. Now, holding money is costly, right? When they are holding money, it's costly because there is an opportunity cost. Maybe you can invest and then get some coins on it, right? So he's trying to say that there is an alternative way of holding money, which is like you holding an optimum kind of money. You shouldn't be holding more money and you shouldn't be holding less money as well. So he actually came out with some calculations or with for the formula that we are going to use to do that. So he said that it will therefore be prudent for an individual to spend idle cash on bond, right, to earn some interest. So if you have a cash which is there and then you are not using it, it is very prudent for you to actually invest it and then get some coins on it. So in resolving this, the individual would have to minimize the cost of holding cash balance over a particular year brokerage fee, right? So he actually came out with this. Brokerage fee is going to be equal to Y over K, where he said that Y is the income and then, sorry, where he said Y is the income and then K is the number of times that, or the size of withdrawal, right? So now what he is trying to say is that if we're able to know the cost of withdrawing, we will be able to minimize our cost or our brokerage fee and the likes. So this is actually the formula for what our total fees, our total brokerage fee in a particular year. So he said we have to what minimize that. So he said that given that the average cash withdrawal is K over 2, the interest rate of holding cash balances can be given as RK over 2. So average is K over 2, right? So now if you want to have the interest rate of holding balance, you can now multiply it by R. Right? When we multiply it by R, then this is going to let our total cost of transaction. Our total cost of transaction is going to be C, which is the total cost of transaction, is going to be equal to R K over 2 plus B Y over K. Right. With this, we can actually find the optimal value for K. So the optimal value for K is what minimizes the total inventory cost, right? And we can differentiate C with respect to K and then set in the derivative for them and then get our final distance. So we can, when we differentiate everything, when we differentiate it, then we will come and then arrive at the formula that we are actually expecting for the day, which is going to be equal to K is equal to right. So this looks like um economic order quantity, right? So this K is trying to say that the efficient or the optimum amount of money we have to hold, where the 2 is there, and then the Y is the income, the R is the interest rate, the annual interest rate, and the B is the brokerage fee, right? So if you're able to get all of them here like this, you are going to get, and then once you simplify it, and then you get a final answer, that's going to be your optimum amount of money that you have to hold, right? So he further on said that, what did he say for? He further on said that people don't carry all their money as cash at once. So they withdraw a portion or a balance of it, balancing the opportunity cost of holding, cost, and transaction. So now, when you're able to do this, you are going to get what? You are actually going to hold a maximum cash in. So let's use this as an example here. Let's say you have an income level to be 1,000. Right? And then since you 10, let's say 10,000. Then you actually have or pay a brokerage fee when you withdraw to be 20. And then the interest rate you are facing here is like 10%. And that is the annual interest rate. If you want to get a monthly interest rate, because you're coming to work based on months, so we can divide it by 12, and I'm sure we'll get around 0.008 or so, something like that. So with this, we are going to get something like this. 2 times B is 20, income is 10,000, divided by R is what? Because we've done 0.9. So we are going to get something around 2236, and that is what's going to give us the optimum amount of cash we are to hold, so that you don't actually get plenty opportunity cost. You get it? Now, after doing this, Tobins also came in with a selection model, how we can actually invest in assets, right? And then he said that money, Tobin said that money does not um money does not fetch interest. So we, instead of holding it in hand, we can invest it in either bond or stocks and the like. So he said this thing is called a risk aversion theory, right, of liquidity preference. So those who like to take so much risk that they always hold bond so long. So if they want to actually take much risk, they hold bond for so long. So those who will either hold portfolio in bond or in cash are more or less like those who are a bit skeptical. You get it? And then the risk averters will only risk only if they see an opportunity that's going to give them something for their investment that they are going to make. Now, that's why something came in. Initially, we spoke about the Tobin scale, right, to measure the value of FM. So now it went on to give us this formula. So he said that if we actually hold bonds for two reasons, right? We hold assets for two reasons, which is we hold them to get what? Either interest or capital growth, right? So our expected return is normally going to be what? Our interest rate and then our capital growth or capital gain, right? Or loss or anything of a sort. So that's what he said. Now we also have the Friedman's restatement theory, which is said that money is considered as an asset. So we demand it. So demand for money is stable, but it is not constant. So substitution for money is not only financial asset, but also physical asset as well. We don't like it's more or less like taking us back to the barter trade, the trading days. So he said that money, wealth can be in money, bonds, equities, physical or non-human goods, and also human capital as well. So factors influencing demand for money includes the price level, real income, rate of interest, and the rate of increase in price level, right? So inflation, right? So that is what was said in the slide, and I've just tried to summarize them without using the slide. So when you get time, you take the slide and then you read, you reread, read, and get more understanding. Right. So let's see. So when you get time, you can go through it and then. So I'll pause the video and then I'll end this session here and then I'll see you in the next video. Bye. One class paper of my friend, son. Oh.